I've helped a complete stranger make $1,000 per day. As you can see here, this student of mine posts wins almost every single day, up to $1,000 per win. Now, if you want to do the exact same thing, I'm going to be breaking down for free my complete trading strategy. This is exactly how you can do the same thing, so make sure you watch until the end of this video. First things first, every single trading plan needs 4 things. It needs a bias tool, a structure tool, a trading zone tool, and an entry method. So what we're going to do in this video is go over each of those things individually, and then we're even going to discuss some psychology. So first of all, a bias tool. What is my bias tool? So I like to look for my daily bias. Sometimes I look for weekly bias, but typically it's just daily bias. So how do I identify my daily bias? So I like to look at 2 things. So first we go to the daily time frame and look at the previous daily candle, and then we look at the previous 4-hour candle as well. So if the previous daily is bearish and the previous 4-hour is also bearish, then the bias is bearish. If the previous daily is bullish and the previous 4-hour is also bullish, then the bias is bullish and I'll only be looking for buys. If they're mixed, we prioritize the daily, but typically we can trade in either direction. It's like if the daily is bullish and the 4-hour is bearish, then we want to be looking for buys. But if sells make sense, like there's an external fair value gap or something like that, then we can look to take sells as well. But typically we look at the previous daily candle and the previous 4-hour candle to determine our bias for the day. So if we do that right now, you can see that the previous daily candle is in fact bullish. Strong bullish. We've been bullish for quite a while now. So if we look at the previous daily candle, you can see that that is in fact bullish, which means that either way we're going to be prioritizing buys today. But if we go to the 4-hour time frame and see what's been going on there, you can see that the previous 4-hour candle is also bullish. If I just draw a circle around that, you can see that. This means that the daily bias is in fact bullish. Why? Because the previous daily candle is bullish and the previous 4-hour candle is also bullish, which means that the daily bias is strongly bullish. So we're going to be looking for buys today. Now that we've got the bias tool out the way, we now need to talk about trading zones, or specifically support and resistance, or even more specific, fair value gaps and liquidity, because that is exactly what I trade. So what we're going to do is we're going to go over fair value gaps first, and then we're going to go over liquidity, and then we're going to go over how to pair these 2 things together. So let's do that right now. So a fair value gap is made up of 3 candles. There's obviously the first candle, then there's the second candle, and then there's the third candle. Sounds pretty self-explanatory. But with the second candle, this is what's known as the expansion candle, which means that this is the move. This is what determines the direction of the fair value gap. The first candle can go in any direction, the second candle can go in any direction, but this will determine the way the fair value gap goes. And the third candle can also just do whatever it wants, pretty much. So for a bullish fair value gap, all we need is a bullish expansion candle. For a bearish fair value gap, all we need is a bearish expansion candle. So if we look here, you can see that there is a fair value gap right here. But what direction does it go in? To help us identify this, we're going to look at the first candle, which can go in either direction, the second candle, and then we're going to look at the third candle. So the first candle, right, is bullish. Doesn't really matter what direction this goes in, but as you can see, it is bullish. The second candle is bullish, and the second candle is the expansion candle, and this decides whether or not a fair value gap is bullish or bearish. And the third candle is bearish, but that does not matter as well. So if we just focus on the second candle, you can see that that is in fact bullish, which means that the fair value gap is bullish. So we've got a bullish fair value gap right here, but to make sure it's a valid fair value gap, we want to check that the wicks do not overlap. So with the expansion candle, you want to make sure that the wicks that pass through it do not overlap, which means that the top wick of the first candle mustn't overlap with the bottom wick of the third candle. And as you can see right here, they do not. You draw a line at the top wick and draw a line at the bottom wick, and that is your fair value gap. And to actually draw it, you take a box, you drag it from the top wick of the first candle and take it to the bottom wick of the third candle, and then that is your fair value gap. That is that. That is a bullish fair value gap. Why? Because the expansion candle is bullish. The top wick of the first and the bottom wick of the third candle do not overlap. So this is a valid bullish fair value gap. Now, how do you actually trade fair value gap? So what you want to do is you want to wait for price to come back into this area, this gap, this fair value gap, and wait for price to show signs of respect. There's two things price can do when price comes back to a fair value gap. It can either respect it or it can disrespect it. If it disrespects it, then the fair value gap becomes inverted, which means it's inversed, and we'll get into that at a later date. But what we're going to do now is we're just going to look at how price reacts to this fair value gap when it comes back down to it. So as you can see right here, price came back into this fair value gap over here, reacted to it, respected it, and then continued up. Now, I would have entered my trade position if I was trading on the 15-minute right here. I'd have put my take profit up here, something like that, my stop loss just below here, something like that. Now, we're not talking about entries here. What we're talking about is fair value gaps. So if we just look at this, you can see that price creates the fair value gap. We've gone over why it's valid. Then it comes back to the fair value gap. As you can see, it wicks it and completely respects it. When this candle closed, I would have got in for my entry, and that is how you would enter trading fair value gaps. In this video, we do not need to go over inverted fair value gaps or inverse fair value gaps. All we need to go over are normal fair value gaps. So what we would do is, for a fair value gap, we would look for these three candles specific format. So it's the top wick doesn't overlap with the bottom wick of the third candle, and that's your fair value gap. And then you wait for price to come back to it, respect it, and take your entry there. Now, liquidity. What is liquidity? So there's two types of traders. There's institutional traders and there are retail traders. Institutional traders are people with lots and lots of money, typically big banks, Barclays, Lloyds, HSBC, JP Morgan, all of those places. They're institutional traders because they're institutional, but two, they have lots and lots of money. Now, retail traders, think of it like retail shops. Like you go to the shop, it's quite cheap, that's retail, and you buy what you need and then you go about your day. Whereas these people do it for a living, typically. Now, retail traders, these have less money than institutional traders. Institutional traders have more money than retail traders. So for retail traders, for me to enter my 1 lot position does not really matter. 10 lot position even does not really matter. But for institutional traders, to enter their 100,000, maybe 1,000 lot position, they have to have a lot of liquidity. This means that basically we have, as retail traders, as a collection, we have a lot of volume to trade with. We have a lot of liquidity to trade with. We don't do much damage when it comes to liquidity. Whereas institutional traders placing their trades, they have a lot of liquidity to take, and they need to take a lot. And sometimes what happens is there's not enough liquidity. So how Forex works basically is, if I want to buy 10 lots, then there has to be a collection of someone selling 10 lots. Now, this can be one person, or it can be 10 people selling 1 lot, or it can be five people selling 2 lots. Whatever it is, it has to come to 10. There has to be 10 lots being sold if I want to buy my 10 lots. Yeah? Now, that works the other way around. So if you enter in a sell position, there has to be 10 lots being bought. But what happens with the institutional traders, as we've just discussed, is that they don't have enough liquidity to fill their positions all the time. Like, they'll be looking to buy 1,000 lots, maybe something stupid like that, which is like millions and millions of dollars. Sometimes there might just be like 800 lots being sold and they want to buy 1,000. So they have to make that extra 200 to make that 1,000 lot position. Yeah. So how do they make this 200 lots? Let's just drag this over here, making sure this is still easy to follow. They have to find 1,000 lots to fill their buy or sell position. There's only 800. They need to make 200. How do they do that? So Forex is a zero-sum game. As we've just discussed, if you're buying, then someone else must be selling. And to get into the markets, you have to buy. To get out of the markets, you have to sell. If you take a buy position, regardless of what direction it is, if your stop loss gets hit or your take profit, if you take a buy position, you will be getting out with a sell order. Now this can be a limit order or, a live market execution, but typically, 100% of the time, a stop loss or a TP order for a buy position is always a sell order. If you buy one lot, to get out of that trade, you have to sell one lot. Simple as that. The profit is the difference in price. That's it. Now, this means that when you take a buy position and you put your stop loss somewhere, you've got a sell order right there, which means you're going to be selling your position when price reaches that level. So if you get in for a position with one lot and place your stop loss to close the entire position, that means that you've got a stop loss for one lot somewhere, wherever you've placed it. There's one lot stop loss. Now, what happens with the retail traders is they typically have the same stop loss placement. Like all of us have the same stop loss placement typically. So what will happen is institutional traders will target that stop loss and also pending orders, which we'll get into in 1 second. So with the stop loss, they will target the stop loss to generate the liquidity. Now, how does that work? So let's say that they want to buy. Institutional traders want to buy, okay? Let's say they want to buy. Now that means that 1,000 has to be being sold, but there's only 800, so they have to get 200 lots to get sold. So how do they do that? Well, they can see with the footprint charts, we don't need to get into that, but they can see and also guess that there is a lot of stop losses below this low here. A lot of stop losses below this level right here. So what they're going to do is they're going to target that stop loss or that area, which will execute two things. One, the stop loss for the people that are currently in the buy position, which will generate 100, let's say 100 sells, because they're sell orders to get out of that position. They will trigger 100 stop losses. And because price is going down, there's going to be those idiot traders, the 99%, which you're not going to be at the end of this video, that will also execute sell positions because they think price is going to continue down. Let's say that's another 100. So they've executed limit orders and market orders as well. They've executed stop losses, which will be people buying the market, which is what they want to do. They'll target the people who are already in the buy position. They'll target their stop loss, which will generate sell side liquidity because they're selling the market. And they'll also get people into their sell positions to generate more sell side liquidity. Yeah, simple as that. So with that sell side liquidity, which would be 100 and 100 here, that generates the 200 sell side liquidity, which they need to add to the 800 currently available, which will equal 1,000. So they want to buy 1,000 lots, but they can only buy 800 max. So what do? They target people's stop loss to generate liquidity in order to fill their massive positions. And that is how liquidity works. That is the metrics of liquidity. Now you should understand how liquidity works. It is institutional traders targeting certain levels where there's stop losses and pending orders so that they can fill their positions. Now that you understand that, we can now discuss where liquidity is resting. Liquidity is resting in like 4 places. So there's 4 main places. There's equal highs and equal lows, which we're going to discuss in a second. And there's also previous highs and previous lows. Now in a move up, price will always target buy side liquidity. And in a move down, price will always target sell side liquidity. So as you can see here, we've got sell side liquidity right here. We've also got buy side liquidity over here. What happens? Price then breaks this low here, takes out this liquidity, then has a nice move up to this area over here, taking out this liquidity. Now think about, this is how it works. This is a live example. So let's say you're in a buy position, you get in a buy position over here. Where's your stop loss going to be? It's going to be here. Take profit might be up here, doesn't really matter. Your stop loss is going to be over here. Now, so they take out your stop loss, then get in their buy position anyway. And when they see this, when this move happens, what's going on is people are also selling. Okay, we've just broke this low, so we're going to enter our sell position here. Where's our stop loss going to be? Previous high. Oh, look, the stop loss gets took out, and then we continue down. But what's going on again is price is going up. All these stupid retail traders are like, oh yeah, let's get in for a buy position right here because we just took out the highs. Where's our stop loss going to go? The lows. Look what happens. Price targets the lows, but then has a nice massive move up anyway. That is how it works. Price will be manipulated by the institutional traders to generate liquidity in order to fill their massive positions. That is what it is. So as you can see here, we've got liquidity at the lows, liquidity at the lows, liquidity at these lows, and the highs as well. We've got highs here, highs here, highs up here, here, here. Like every single high is where liquidity is. Every single low is where liquidity is as well. And it also happens in equal lows and equal highs. And it also happens in equal lows and equal highs. And this can be in the form of consolidations, or it can be in the form of just equal highs and equal lows, like dotted lows, double bottoms, and double tops. There's liquidity right here. There's also liquidity over here, like every single high, every single low. And that's pretty much it. Like, it's pretty self-explanatory. Once you understand it, it's pretty straightforward. But what we want to be doing here is when price takes out one side of liquidity, we want to take out the other side of liquidity. And now there's names for both sides. So at the highs, all the highs is buy side liquidity. This is buy side, buy side. Why? Because people in sell positions are going to have their stop losses above these highs. And there's also going to be pending buy orders ready to get in for a buy position to try and catch a nice move up. So there's buy side liquidity at highs because that's where sellers' stop losses is. And to get out of a sell position, you have to buy. And with the lows, that is sell side liquidity. Why? Because people who are buying the market have their stop loss there. And there's also pending sell orders in the form of executions. Why? Because price is going down, price thinks price is going to continue down, and also if you're buying, you have to sell to get out. That is how liquidity works. That's it. Like, what you want to do is when price takes out one side, you want to target the other side. Simple as that. So when price, obviously you have to pair that with other things. You don't just do that purely and it works every time, because it doesn't. In ranging markets, it might work, but in moves up and down, it won't work, because when we're having a nice move up on a lower time frame, we are generating all of this sell side liquidity, which obviously eventually gets took. But as you can see, that would not work on this time frame. We would only be targeting buy side. But in a ranging market, you can do the same thing. You can take out sell side, target buy side, take out sell side, target buy side. But when you pair it with other things, so if you're looking for buy positions and we take out sell side, then you can get a buy position there. You can have a nice move up. As you can see right here, we have sell side liquidity right here. We take that out and then we start continuing up. So I would enter my sell position. Obviously with other confluences, I would enter my sell position somewhere like around here. Now I'm going to be showing you how to pair this with fair value gaps. So what you want to do with fair value gaps is you want to basically use the fair value gap as your entry and use liquidity as your exit. So we have a fair value gap right here because we have 1, 2, 3. We have a bullish expansion candle right here and the wicks do not overlap. So this is a valid bullish fair value gap. Correct. Now, how do we trade this? So we wait for prices to come into it and then respect it. So we just take our buy position right here with our stops just below here. And where do we target? Well, what we can do is we can decide where we can target. So we can either target here, we can target the internal liquidity, or we can target the external liquidity. We're targeting internal liquidity right here. We can just target a previous high so we can get in when price is respecting this fair value gap, even here if you wanted to. Like, you could really, I would probably get in here. Then you can just target this up here. Simple as that. A nice 1.9 R. Simple trade, easy trade, stupidly easy to be honest with you. And that's as simple as it gets. Now to actually draw liquidity, you want to get a line, hover over that get trend line. So if we just go over to the left hand side, hover over this, it should say trend line tools. You click the arrow, highlight trend line, click favorite. It should pop up here. Then you want to draw it out. You want to go to edit, settings, text, put the $ in, click save as, and then it should say like liquidity, then save, and then it should appear here. So you click liquidity and then it's there. Simple as that. So now you can actually draw liquidity. But that's what you want to do. Now there's obviously two things. We're not going to get into this yet. I'm going to make a video on this in the future, but there are two things. It's called internal liquidity and external liquidity. We're not going to worry about that yet. All we need to focus on is liquidity as a whole. But I've shown you fair value gaps and I've just shown you liquidity. So now we have our trading zone. So I would identify my fair value gaps and then I would identify my liquidity and I'd look to trade to those things. But now we need to pair this with a structure tool. So what is my structure tool? My strategy revolves solely around AMD. So what we're going to be doing now is going over AMD in complete depth. So what is accumulation? Accumulation is the build-up of long and short positions. Simple as that. There's equal highs and equal lows. That's what it is. It's a consolidation, and there's buy-side liquidity over here and sell-side liquidity over here. Liquidity on either side. This is the build-up of positions. Now this will typically happen during the Asian session, which you can, if you want to find out what the Asian session is, just search it up. Very straightforward. It's like 10 p.m. BST to 7 a.m. BST. You'll have to set that in your own time zone. But that's what accumulation is. It typically happens during Asian session, and it's the build-up of long and short positions. Now, as we've just discussed with liquidity, there is buy-side and sell-side liquidity on equal highs and equal lows. There is equal highs and equal lows right here in this consolidation. There is buy-side liquidity and sell-side liquidity. Simple as that. Now, once price has done this, once price has accumulated these positions, we then get the institutional traders who want to take their massive trades, who make the massive moves in the market. They're market makers, as you may have heard referred to as. Now, so what happens here? So, as we've just discussed with liquidity, there might be institutional traders wanting to trade with 1,000 lots, but there's only like 600 lots available. Yeah? So how do they make this extra 400? What they do is, as we've discussed, you should know this now, what do? They target one side of liquidity. So if they want to buy, they will target the sell side liquidity, and if they want to sell, they will target the buy side liquidity, because if you buy, you have to sell, and if you sell, you have to buy. Simple as that. So if they want to take 1,000 lot trade in a sell position, they will have to target the buy side liquidity, so that there can be 1,000 lots being bought for 1,000 lots being sold. So they have to target buy side liquidity if they're selling 1,000 lots, but there's not enough to fill that position. So what do? Target buy side, as I've just said. What does that look like? That is called manipulation. They manipulate price to target the buy side liquidity. As you can see, this is the buy side liquidity. They take this buy side liquidity out, which executes hundreds of thousands of buy orders. So there's like, in simple terms, let's say there's just like 1,000 buy orders there being executed. And they wanted to sell 1,000 lots. So now there is enough liquidity to fill their position. So they've got this buy side liquidity. They made price go up so everyone bought. Then they execute their sell position, and then price goes all the way down. But what we're talking about here is simply just this manipulation, this move up, which is called manipulation. This typically happens during London session. So we have the consolidation, then we have a fake out, and that is manipulation. This is what we're discussing here. So manipulation will typically happen during London session, and it is simply just to target one side of liquidity, only to reverse and go in the other direction. So then, once we've took out this liquidity, we've filled the position, we then have the distribution move, which is one massive move down. Simple as that. We have our accumulation, which is the pending orders and the build-up of positions. Then we have the manipulation, where the institutional traders don't have enough liquidity to fill their position, so they target one side of it to generate the liquidity to fill their position to take that massive trade in one direction. And that is AMD in a nutshell. We have our accumulation in Asian session, which is the build-up of long positions. We have the manipulation phase in London session, which is targeting one side of liquidity. And then we have the distribution move, which happens in between London session and New York session, which is that big move after we took out liquidity. So we accumulate positions, take out liquidity, generate enough liquidity to make a massive trade happen. Then when the massive trade happens, we get that distribution where price moves massively. Simple as that. That is AMD in a nutshell. Now to just draw this out for you, we simply just have our accumulation like this, then we have our manipulation, and then we have our distribution, just like that. That is what AMD is. Like, that is that in a nutshell. It's accumulation, manipulation, distribution. Now, I like to trade the distribution move. Obviously, it's the biggest move, it's the best move to catch, and it's the most reliable move as well. So now we've actually gone over AMD and what AMD looks like. Now it's time to go over my entry method. So what I do is I bring all of this together. So I look at my daily bias and find out if it's bullish or bearish. Then we go over fair value gaps and liquidity. We identify fair value gaps and liquidity. Then we look for AMD. And then I look for my entry method. What is my entry method? Now, every single time, without fail, my entry method is the end of manipulation, start of distribution. So what I look for is price to manipulate into a fair value gap. Like, let's just draw this out. So we have our moves up. We have our we have a nice distribution move. Then we have accumulation, manipulation, distribution. We have our accumulation here. Then we manipulate, and then we distribute. Now, what typically happens is we will manipulate into a external or internal, which is any time frame, fair value gap. So we will manipulate into a fair value gap, which is where I will take my buy position. So we have a bullish fair value gap formed in a previous distribution move. Then we accumulate. Then we manipulate into that bullish fair value gap, which is where I take my buy position. And then we continue up, nice and easy. That is it. 9 times out of 10, that is the trade I'm taking, and it works like 7 times out of 10, 70% win rate. Simple stuff. So what we're going to do is we're going to look at this on the market now. So what I would look for is an accumulation, manipulation, and distribution. So as you can see right here, we've had our accumulation, which comes after a previous distribution move. We have our accumulation, then we have our manipulation to the upside, and then we have our distribution move to the downside. Now, how would I enter this trade? So as you can see right here, there is a valid bearish fair value gap, literally just above the accumulation range. So I would literally, as prices respected this level, I would enter my sell position right here with my stop loss just above here, or maybe even above here, and I'd put my take profit at this area down here. And that is as simple as it gets. You look for the daily bias, then you look for the market structure, then you look for the fair value gaps and liquidity, then you look for your entry method, and then you take the trade. And that is as simple as it gets. If you want me to help you make $1,000 a day, just like that complete stranger in my Discord server, click the link below and join Fasttrack Forex now, just like Mims did, to get these results. I'll see you in there.